I want to link my presentation around 4 reference points. One is a quotation by the famous economist Professor Feasibility, who addressed during the Major Depression, who addressed the Macmillan Committee, and said that the entire depression was the result of a huge labor market problem, which is the wage. How could people expect to be employed if they expected a king's ransom? One point. On the other side, a second reference point is Keynes's letter to the American president, saying that he thought there was a false dichotomy between the public and private sectors, and in the middle of the crisis, really, the two could be interchanged. A third quote, a reference point, is by the professor at Oxford, Isaiah Berlin, who talked about the parable of the hedgehog and the fox. Now, the fox is considered an animal which is very clever and sharp and knows lots of little things, but the hedgehog is considered a very slow, lugubrious animal, and it is said that it only knows one big thing. So perhaps in macro policy, perhaps in the debate on growth and employment, we need to focus not on lots of little things, but on the one big thing. And the last reference point, perhaps coming to a little bit of granularity about Pakistan, is an interesting factoid. Pakistan is about to undertake an investment program in Tarbela, which will be to generate power in the 4th tunnel, and that is based on a loan from the bank, World Bank, and the cost of generating power will be 2 rupees per unit, as opposed to the other private power generators, which was pointed out earlier, are something like 28 rupees per unit. Let me try and link these 4 things together. The problem is, at the moment, the global economy has gone from fairly decent growth of from fairly high 5%, and it slumped into a contraction. There was a pickup by 2009, 2010. The problem is we're going into a second dip. Europe is going into a second dip. Various parts of Europe are going into a second dip. Even the US is not doing great. And the IMF's latest projections are a downward revision of their growth projections from 4% to 3.5%. So GDP not doing terribly well. The problem is that what this has meant in terms of the global labor market, it has meant that we have gone from an unemployment level of about 171 million to an unemployment level of 197 million. Now, when I use the word unemployment, it does not take into account any of the issues that Dr. Rashid Amjad was talking about very carefully. It does not take into account the quality of employment. It does not take into account working wages, conditions, but as a macro variable, as a heuristic device, as an order of magnitude, something like 27 million jobs have been lost, according to our estimates. If we want to take considerations of the quality of jobs, about non-registration of unemployment, then we have an estimate of discouraged workers of 29 million, which means that the total jobs lost in this crisis are about 55 million. Those are mostly concentrated, as you can see, in the advanced economies. And what the crisis looks like now, and what we want to learn from the crisis, is whether we can take away some lessons for countries, is that the crisis at the moment seems to have morphed into a 3-stage crisis. It's gone from corporate risk, which was in the beginning we saw with Lehman Brothers, to sovereign risk, which is now the high debt, which is Portugal, Ireland, Greece and Spain, now increasingly Italy. And the third stage is there is now a double dip risk, which is pretty much realized now. A second metaphor for the crisis is that it has had a long half-life. The last phase seems to be very protracted. And the problem is that the policy space has been reduced as the crisis has gone on. So not only do we have a jobs deficit of 27 million or 55 million, but we have an issue of the huge stimulus that was undertaken, and something like $5 trillion was the estimated amount of stimulus, fiscal stimulus. That stimulus, what happened to the jobs? Did it not create any jobs? So it's an issue for macro policy. If there was a huge concerted stimulus, why is it that we are still confronted with a shortfall of 27 million jobs or 55 million? But that requires an understanding of just the broad orders of magnitude. At the moment, the previous chart, since it's a little complicated to go back, the previous chart indicated that we had close to 200 million unemployment. Every year, the labor force growth, demographic growth, adds about 40 million. So what we estimate that the stimulus has done is that it has just allowed growth to recover to catch up with the natural rate of labor force growth. Can I go on? Thank you. The issue is, could we have done better with the stimulus? Could we have cut a dent into the 27 million? Did the stimulus work? This goes back to another project that the ILO has undertaken with the World Bank called the Policy Inventory. Called the Policy Inventory of Crisis Responses, which shows an interesting finding that if you look at sectoral distribution of the stimulus, and we said it comes to around, well, the sectoral distribution comes to around $2 trillion. In the advanced economies, 66% of the stimulus went to the financial sector, which means it did not go to the real sector, which means it did not work very well in terms of generating jobs in the real economy. It just allowed a recovery so that the job growth rate was equal to the natural growth rate of the labor force. So we've got an issue of targeting of who got the cash, and we do feel the need that there is certainly a role for stimulus policy. We have a problem. Let me illustrate to you if this works. Is this not working? Can we go ahead? Oops. Forward, please. Yep. So we've got basically GDP growth picking up a little bit in advanced economies, but employment growth flatlining. We've got in Europe a flatlining of employment growth. We've got in East Asia a flatlining of employment growth. We've got in Latin America a pickup in some aggregates, but the big parts of Latin America, Brazil, etc., flatlining, and Southeast Asia again doing badly. Africa, the only place we have quarterly data for, doing badly. I'd like to come to levels of unemployment, and that has a very important bearing for macro policy, which is if you look at this matrix, and if we put GDP growth on this side, if we put unemployment on this side with all of its imperfections, there should be some proportionality between them. In the crisis, comparing early projections to the middle of the crisis, we find off-diagonal elements, which means that GDP fell by far more than unemployment went up. That, presumably, is based on the social stabilizers, largely in advanced economies. That's the good news. The bad news is that in the recovery period, if we take the most recent period to the depth of the crisis, we have the same matrix, and you look at the off-diagonal elements, they're all off-diagonal, which means there's been no recovery in unemployment at all in the majority of the countries that are there. If we go next to looking at transmission channels of the crisis, we've got exports, we've got consumption, and we take with the same matrix exports on this side, consumption on this side. The crisis was largely an export crisis, consumption was cushioned. In terms of the recovery, again, we got the same thing, which is exports are digging a way out of the hole of the crisis. Consumption, which is the large driver of growth, is not doing very well. Now, what does this mean in terms of recovery, and what does this mean in terms of macro policy? Let's set up what is called output gap. The large green line shows what GDP would have been, global GDP, if it had continued growing at 3.2%, which is the pre-crisis growth rate, going up like this. The lower line is the dent caused by the crisis, and then projections based on what GDP growth rates might be. What the GDP gap diagram shows is that we will not get a recovery in the hole done by the crisis, even if you assume that GDP growth rates pick up to pre-crisis trends of 3.2%, exceed pre-crisis trends of 4%, we have to assume heroic assumptions of 6% GDP growth to fill the gap, the output gap created by the crisis. What is more worrying is the employment gap, similar line. You've got the upper line, which would have been if there had been a continuation of pre-crisis trends. The employment would have grown at this rate, and then you've got the lower line, which shows the hole dug by the crisis, and then we have various scenarios whereby we can try and get a recovery of the jobs lost, the 27 million or the 55 million. The problem is that this also assumes that a 5% GDP growth rate will be needed to close the gap by 2016. Now, so much for the empirics. Where does the policy come in? The policy comes in because at a global level, the debate is about that number, the gross fixed capital formation at a global number. That number during the crisis went down to 15%. Middle of crisis estimates still don't show recovery for advanced economies. So one, a very important lesson, investment, gross investment is not picking up at a global level. Why? And here's the clincher. I think we should ask the students to recognize this equation. If you take budget balance, the private balance, this should equal the current account balance. Forget the equation, look at the numbers between 2004 and 7, which is pre-crisis, the way in which the private sector and the public sector run, which is what the debate was about earlier on this morning. The private sector usually overspends, it runs a deficit. The public sector usually runs a surplus. That is the rate of the capitalist economy. What happens with the crisis is, if you look at the gap between 2007 and 2010, it's the private sector which is now running a surplus. IBM now is richer than the US government. It's cash stockpiling. And the public sector, because of the huge stimuli, the $5 trillion or the $3 trillion, is running a deficit. So we have a macro policy issue immediately, which is, if you want recovery of growth and employment, then I will need more than 5 minutes. I think if we need a recovery of growth and employment, then you do need a pickup in investment, but the pickup in investment is not coming at a global level. That kind of echoes Pakistan as well. The private sector is not investing, the public sector is laden with debt, but if it stops investing, aggregate demand will fall. So that is the first macro policy lesson. So we've got to consider, in the context of the advanced economies, what are the macro policy options? If the public sector is laden with debt, then the cost of borrowing, the bond yields, which is the cost at which governments borrow, go up. So you have Southern Europe, whose bond yields are very, very high. And they have a problem. Do they invest? Kind of like the problem Pakistan has. Should there be public sector austerity or should there be stimulus? There is a huge problem. Greece, Ireland, Spain, Portugal have no growth drivers left in them. Because of the austerity, we can see what's happening to them. Secondly, the issue is that with pegged exchange rates, and Dr. Shahid mentioned the pegged exchange rates in the morning in the context of Pakistan, the euro area now finds itself in exactly the same problem. It's got pegged exchange rates, it's got the euro. If it's got the euro, then there can be no external devaluation to improve competitiveness for Greece, Ireland, Portugal and Spain. If there cannot be that external devaluation, then all the cost of adjustment of the capital market falls on to the labour market. And those were the flexible labour market adjustments that Professor Ashwini Seth talked about. The point is, that's a slightly unfair set of adjustments if the labour market has to do all of that work. The third set of issues is based, of course, on the recent election in France and the split between Germany and other countries, with Angela Merkel, the Prime Minister, saying, the Chancellor saying, that we've got to stick to competitiveness and austerity, and the rest of Europe saying, but where is the growth going to come from? It cannot come from external sources. It's all got to be done internally, but if it's done internally, we have no drivers of growth left, which is why the call for the new growth compact. So if you like, the debate in Europe mirrors the debate that was being discussed this morning of the need for a new growth compact, the need for more inclusive growth, the need, as Professor Ashwini said, for more and more transfers. If the process of growth is not generating sufficient employment, then you've just got to throw transfers at the problem. Whether it is Brazil with the Bolsa Familia program, 22 million households, China, another 22 million households, NREGA in India, very innovative program, non-repeated, and therefore that kind of program. I think we need to come to Pakistan, and that is, let me present, everybody's presented a nice diagram, let me present my own diagram on Pakistan, which is the fluctuations in GDP. So the yellow stuff is the GDP. So we've got GDP growth rate on this side, and then we've got the other macro variables, which is savings and investment, exports, and the budget deficits on this side. Clearly, one important thing that does come out very clearly, and I think Professor Irfan Mahmood pointed out this morning, is whatever else happens, when you've got high GDP growth rates, when you've got these spikes in GDP, the one thing that is critically going up, there are two factors that are going up. One is investment, and the other is the share of the government of the public sector. Two variables go up very clearly. Let's see that in here. We take GDP growth between 80 and 90, second period 92,000, I've got the other two periods in the next chart, and we divide it into the drivers of growth. You see the period of high growth, 80 to 90, what is significant again is that investment is very high and public expenditures are high. A period of low growth, 90 to 2000, investment and public expenditures both very low. If we go to the next period, 2002 to 2007, again, investment is very high, fine, that you would expect, but public expenditure also very high, and then you get the slump, and of course there is a huge slump. So what are we saying here in terms of what are the policy options that can come from the global debate to the Pakistan debate? And I yield to you what might be relevant, because you are much more aware of the granularity compared to the more sort of bird's eye view of the global economy and the policy lessons I've tried to draw from there. The most important thing is that high growth obviously is correlated, well, definitionally to investment, but very much to public investment. And hence, the fourth factoid that I presented in the beginning, all public investment need not be considered inefficient. There's been a lot of discussion of the new growth strategy, of the planning commission's current new growth strategy. That debate is not a new one, it's a fairly old one. The point is, the new growth strategy says, A, markets are weak, B, that the public sector is inefficient. I'm not sure that those kinds of numbers show that the public sector is inefficient. Yes, maybe the public sector efficiency is not in production, maybe the public sector inefficiency is in distribution, but certainly that seems to be the way to go. The second point is that at the moment, private savings are greater than private investment. There seems to be a huge capital outflow. You hear anecdotal accounts of investment, of textile investment in Bangladesh, of textile investment in Cambodia, even Laos, huge transfers out of here. At the moment, therefore, the issue does not seem to be one of worrying too much about inflation. Yes, we have an issue of inflation. The question is this demand-based or cost-push? If it's not demand-based, if it is indeed cost-push, if it is based upon on food prices, on fuel prices, if there is significant capacity, under-capacity utilization, then we do need to worry much more about the investment variable, and we do need to devote a bit of space, fiscal space, to demand management. The third point, and I see Ashraf Saab looking at me, the third point I do want to point out, in looking at the growth strategy, is that Pakistan's banking spreads are very high. They're 6.5%. That is well above the median of the global economies. And therefore, we do need, yes, this is where we need the new planning commission strategy, which is introducing competition, which is to reduce the cost of borrowing so that we can increase investment. There is a very worrying issue about decline in manufacturing. The share of manufacturing has gone down, and that certainly is an area that we need to look at the global debate, which is one of moving towards some kind of industrial policy. Let me stop there. Thank you.